Hey everyone, welcome to this week's Nasdaq Dorsey Wright podcast. We're talking Thursday, April 27th, coming out Friday, April 28th. My name's Will. I got my friend and colleague Miles with me. We're going to run through some of the chart updates that we saw over the past week, and we're just joking around that it looks like some of the indices are going to be flat over the past 7 days.
Yeah, we're saying a whole lot of action for a whole lot of nothing, right?
Yeah, like a lot of action like beneath the surface if you look at some individual names, which we'll talk about. But headline numbers, what like Nasdaq Composite was down 2.5 coming into today, and it's about up
Yeah.
2.5 now.
Down 2.49 to be exact, and we'll be just about flat, maybe down, all things equal, down about 15 basis points after today.
Over the past 7 days.
Yeah.
Yeah, with just a whole bunch of like headline just flat closes. A lot to talk about beneath the surface, a lot to talk about for sectors. Before we get away from the Nasdaq Composite, I did want to highlight for the point and figure connoisseurs out there, the default chart is looking like we're going to post a shakeout pattern. So that's the form the double top, then you broke to give a sell signal, then you reversed up into X's. That's your traditional action point on the shakeout pattern. It's a bullish pattern. It's in a positive trend. I mentioned this on the morning update the other day, and I think, Miles, you would agree here that maybe the bigger story is that resistance at 12,200 for the Nasdaq Composite. You put it in September of 22, tested it in February of 23, again in March of 23, again in April, and now it look like we're going to get a test again.
Yeah, that's the big point, right? It's nice to be putting in, to kind of go back at you and say, hey, listen, it's bullish. It's nice to see, higher bottoms. Of course, we did post that sell signal, so slightly lower. But if you look back, through March, into February, we're off those bottoms pretty nicely down at 11,000 or so. So nice to see that for a bullish talking point. But I think, like going back to what you said, we're going to have all eyes on that resistance because that's not just from this year. That's like you said, dating back to September. So
yeah, and then once you get above 12,002, so 12,300 would be like an official break on the default chart. That would be pretty constructive. Other than that, you don't have any resistance until the August 2022 high. So you'd really like to see that happen if you're long the Nasdaq Composite or anything kind of that tracks that. Apart from that, do you want to go to sectors now?
yeah, I think so. I mean, we saw some interesting. I'm actually writing a report piece today. So if this is coming out and you haven't read it, go ahead and check it out. Writing a report piece today that has to do with this recent reversal we got for XLP on a relative strength chart. So measuring XLP, so consumer staples representative versus XLY, which is the consumer discretionary kind of proxy that we use, Spider Fund.
Mm-hmm.
So looking at the two, pretty frequently we like to look at them as a taste of market attitude for risk because you think discretionary a little bit more risk on, staples a little bit more risk off.
Interjection, we're going to put the chart on YouTube, so when we're talking about it, I think this will make a lot more sense. But I'm sorry.
No, you're fine. So we got that reversal on 3.25% backup indexes in favor of consumer staples. So we're seeing, at least from that perspective, a little bit more of a defensive posturing. This, as you can see on the chart, tends to trend, as we say about these things.
Yeah, it trends well.
So consecutive buy signals, consecutive buy signals, consecutive sell signals.
So because generally you're seeing that when this ratio is going up, consumer staples are outperforming discretionary. As Miles was saying, the signals are the longer term, then columns are that shorter term. So that going back into X is on a shorter term basis. It's telling us that we're seeing long term strength for staples and some near term strength relative to your discretionary. It's not a ratio you'd really like to see rising if you were to categorize, chalk up bullish bearish points. We had a bullish point for the Nasdaq Composite. This would probably be more on the bearish side for the market. So keep that in mind. You're never going to have an all clear signal where every single indicator is pointing for you to get into the market. If it was, then it would probably be a top.
And listen, and to kind of ping pong it right back at you in terms of a kind of a bullish point, if you can make it one, is you can kind of look underneath the hood. And we both did some investigation into it, and like, hey, why is a fund like XLP, again, that consumer staples representative, doing really well?
Mm-hmm.
And you look at those underlying constituents, you've got Procter and Gamble and you've got Pepsi, right, who both reported earnings. They make up roughly 25% of the fund, and they both killed it, right? So they're overextended. So, XLK, maybe we can put that chart on the, or not XLK, excuse me, XLP.
We
can put that chart here now. It's had some pretty significant resistance.
Very clear resistance. Yeah.
It's at 77, if I've
Yeah.
got it right. So, I mean, you're going to have to see, saying that those kind of top leaders, those generals, as we call them, they're overextended. To get past that, you're probably going to have to see some support from kind of the smaller constituents, I think.
Yeah, and like Pepsi and Procter and Gamble, those are like grandfather stocks. I
Yeah.
remember, he was like watching whatever was before CNBC, like
Yeah.
writing down the prices.
Get
and, like,
those dividends.
Get the dividends right. Yeah, it's been around, however many years.
Yeah.
Good quality companies, which nothing wrong with that. But also, those aren't stocks that like jump 2 and 3%.
Right.
Typically on a day. Those are huge companies, and as you said, a huge weight in staples. They're well above the top of their trading bands, at least when we're talking about this. So I agree. I think that resistance for staples, XLP specifically on that chart, is going to be pretty tough to get over. I know we're talking about group scores as well. So not just XLP, but like a basket of consumer staples funds. You're seeing a pretty similar move score wise.
Yeah, I mean, that's again going back to kind of the relationship between the spider funds. That's another relationship we like to look at on the asset class group scores page, looking at the consumer staples, kind of group or basket in comparison to the discretionary basket, and seeing how those, kind of interact with each other. We've seen those kind of flip flop at some pretty pivotal environments. You see there at 2022, if you followed that kind of staples signal, or when it took over,
it's a good signal.
Good signal,
yeah.
Right? Likewise, on the other way for, back in May of 2020, a little late to the party, but in general, you got the rest of that, right?
So to be clear, December of 2021, consumer non-discretionary or staples overtook consumer discretionary on the group scores page. So that was a pretty good signal.
Right.
And of course, the fundamental backdrop is that your defensives or your staples or the people or the things that people buy kind of regardless of market environment, and your discretionary, as the name implies, being more of a non-mandated spending, clothing, shoes, discretionary products. So that's some of the background for the rationale. But I know we talk about that sharp jump. Yeah,
we haven't talked about it. We're kind of flirting around it. But yeah, we got that sharp jump. Of course, we've seen, just over the last couple of days, really, it jumped from, at least talking about consumer staples, jumped from around a score of 3.7 or so to, around 4.1, 4.2. So we're seeing a pretty big jump in that. Also seeing a bit of a downtick in the consumer discretionary side of things. It's, kind of adds to the picture between the two. But
yeah, and you don't see that non-discretionary group get much higher in terms of average score. Like you look 5 years back, 10 years back, it's really not often that you see it get higher than 4.0. So if we were to maybe chat up or chalk up another point for bearish or bullish, maybe you put this on the bullish side, given that maybe you don't see it run that much higher. Now that doesn't mean that the group's going down, but maybe it just trades sideways. Rest of the market goes down. That's possible for sure, but it's something to watch because it doesn't typically get too much stronger.
Yeah, it chalked a score of about 4.3 three times, as we can see it, through 2022. Really, since then, I'm talking about consumer staples here. Really didn't get above that point back until 2000. Got to scroll back a little bit, 2016. So we're talking about a 7-year kind of line in the sand where we haven't seen. Now, you could chalk that up towards, some of the market attitude over the past 7 years. Pretty historic bull market, right? With a couple of hiccups in there, of course. But,
Yeah. So, I mean, those are two sectors that I think you should be watching. There's some really great ties between the two. Group scores, relative strength chart that Miles and I talked about. If you have questions about how to get that set up, let us know. Any parting shots on those sectors before we want to keep moving?
No, I don't think so.
Cool. Cool. Where do you want to go next? Do you want to go earnings? Do you want to go S&P?
Let's wrap up with earnings. I think it segues. Yeah. So segues pretty well, talking about a piece we wrote in the report just this week, looking at that S&P equal weighted versus the S&P cap weighted, that chart.
Yeah, go for it.
Yeah.
I don't have it pulled up.
No, you're fine.
Drive it home.
So we're taking a look. We got it on screen now. We're taking a look at the equal weighted index, so SPX EWI versus the cap weighted index, just good old SPX. Looking at it on a 3.25 scale. So we are close to seeing this thing reversing. We're still in a column of X's favoring the equal weighted index. So still equal weighted preference, at least in the short term. And we're on a buy signal, and long term as well. But pretty close to getting a reversing back down. So we've seen some preference in the short term towards cap weighted names.
Yeah, and I think earnings has maybe exacerbated some of that
Yeah.
so far. Maybe because we're not focusing on as a lot of the smaller names. Of course, when any big name in the S&P 500 reports, we're all going to go watch and see what they do. Company number 497. I don't know when they report earnings,
Right.
but yeah, I mean, some of the biggest names, there's seemed like a lot of bullish anticipation for earnings just based off the chart action that you saw.
Yeah.
You saw Amazon coming up, but you saw Meta today being a prime example of something that ran up ahead of earnings, maybe market expecting something good and then got even better, perhaps up like another 15%.
Right.
But I think like maybe the easiest segue would be like Amazon being that discretionary, huge weight in the discretionary sector. They're scheduled to release earnings this evening, so that'll be after this podcast comes out tomorrow. Don't timestamp us on this.
Yeah, we'll have to see. Yeah, big run up. But no, I mean that kind of calls back into the conversation we were just having with discretionary. There's a lot of weight there that could exacerbate it in one way or the next.
Very true. Yeah. And you're saying even like those big cap weighted names in the S&P 500 could push that cap weighted fund ahead of your equal weighted fund. When there's a lot to be said about that. Maybe it's a defensive play. Maybe it's like the mega cap growth defensive established companies tilt again. Maybe it's interest rates. Who knows? There's a lot of fundamental variables that you can maybe chalk up to it. But the technical picture, they're clearing some notable resistance in a lot of cases and high attribute stocks now.
Yeah, you're seeing, I mean, we talked about it, I know in a previous podcast about the title is tech back. Right?
Yeah.
And that's when we were seeing that big kind of run up in tech. We were saying, we're seeing that rotation back towards defensive tech. So I think that conversation kind of, you hear echoes of that conversation again here today, saying that a lot of those tech names are some mega caps.
Yeah. And maybe it's like kind of frustrating because people were getting more alpha opportunity when like the mega caps weren't working. They're like, oh, I can go buy smaller sectors, overweight those sectors, go buy smaller stocks, overweight those different size and style groups. And maybe people are getting a little frustrated now where it's like, oh, it's just the old general.
Just back to it.
You got to go buy more tech again. And which can be frustrating. Don't get me wrong, but you kind of got to take what the market gives you. And trend following is definitely one of those things where you got to take what the market gives you.
Right.
And if there's a change in leadership and you don't like it, the whole benefit of trend following is being objective and following and sticking with that, even though it's like, oh, we got to go buy tech again.
Yeah.
So, and that's not to say other things aren't working. There are plenty of other things that are working, like Staples still look strong. But anyways, that's what I had to say about there. So,
yeah. So, I mean, we talked about Amazon, of course, one thing that will happen after this podcast. So, you'll be watching and still won't have reported most likely. Is Apple too. So keep an eye out on that. That's the kind of alpha of the big tech. Right?
Yeah, because you had like a bunch of the big names go this week. You had Microsoft, Alphabet, Meta, then Apple's next week. So that's another big one to keep. And it's big because it affects the indices heavily. And that's what we mean by that. Any charts you want to call out in terms of earnings, notable movement? I know we talked about Amazon. I mentioned Meta.
Yeah, one thing I'll talk about, is Alphabet, right? So they beat on top and bottom. They announced the continuation of their $70 billion share repurchase program right after hours. They were kind of up. They reported on the same day as one other, not sure which one it was.
Might have been Microsoft, maybe.
Might have been Microsoft.
Maybe.
They were up pretty big after hours and then actually opened the next day flat. Looking at their chart here, pretty interesting kind of perspective. We're sitting at 108, right? Constructive looking chart, broke back into a positive trend, put in a higher bottom right above the middle of the trading band, second consecutive buy signal right there at 108 to bring us to 2023 highs, some pretty interesting resistance. Do have a word of caution here though. I've been following, Google, as we all have, pretty heavily, of course, my sector, but we've seen this thing break back into positive trends, break past some pretty key resistance, and then ultimately fall out of bed. I'll name one right here, and that's back in August, and you can actually see it on the chart back in August. Quadruple top, break back into a positive trend. All things seem to be looking good, just to move down and post new 2023 low or 2022 lows.
Yeah. So you'd like to see what, like 110?
Yeah, I'd like to see 110. I mean, and then from there, even though it's a 4 for 5 or technically acceptable, I'm looking for some consolidation, right? Because we've seen some pretty stout reversals, as in you get, you break past that resistance and then almost immediately you fall down, right?
Mhm.
So I'm going to be looking for move to 110 and then some consolidation in their higher bottoms, put in some firm support around that area before I can really consider it.
Gotcha. Yeah, one name that I'll mention that caught my attention so far in this earnings week has been Microsoft, because it cleared the August 2022 chart highs. I think that's notable. There's probably some established market memory at those August 2022 highs. So it came after earnings, big day, and then followed up today with like another 3% day. So that's taken it above the August highs. Your next level of resistance for Microsoft isn't until 312, which was March 2022, which was another notable intermediate term high for the market. It's a bit overbought right now. So if you're putting some new money, dollar cost at least, maybe I'm dumping all in right now and just spread that cost basis out in the potential that it pulls back, because you had a big inhale, be expected to see some exhales. But overall, really strong picture. Not a lot negative to say technically.
All right, you won me over.
You won me over. Yeah. Full retirement. Here we go. Well, cool. Any other charts? Anything you want to conclude with, or I think we got the message across?
I think we're good.
I think we're good. Cool. Well, thanks everybody. We appreciate the time. We will be with you all next week.